Welcome back to the Deep Dive. Today we're going deep on a chapter you all chose from Benjamin Graham's The Intelligent Investor.
Oh yeah, a classic.
This one's all about stock selection for the defensive investor.
It's like having that roadmap,
Yeah,
for building a portfolio that can weather any storm.
exactly, and I'm so ready to unpack this with you.
It's a classic for a reason. Graham lays out a framework for smart choices, even if you don't have a team of Wall Street analysts. You know what I mean?
Right, so let's dive into that defensive investor mindset. It's not about striking it rich quick, but minimizing risk and making sure you're getting good value for your money. Graham had a real aversion to losing money, didn't he?
Totally. And you see that in his two main recommendations. He suggests splitting your investments
Okay.
between high-grade bonds, which provide stability and income, and a diversified list of leading common stocks for growth potential.
That classic balance, playing it safe and going for those returns.
Yeah.
So how do we actually start building this portfolio?
Well, Graham outlines two main approaches. The first is what he calls the DJIA-type portfolio.
DJI.
Think of it as like one-stop shopping for diversification.
Okay.
You're buying equal amounts of all 30 stocks in the Dow Jones Industrial Average.
So you're basically betting on the overall health of the American economy.
Exactly. It's simple. Hands off. You get exposure to a wide range of industries. But for those who want more control, Graham proposes a second approach, the quantitatively tested portfolio.
Okay. This sounds interesting. Tell me more.
You handpick stocks that meet a specific set of criteria.
I like it.
It's like being a detective,
Ooh,
uncovering hidden gems.
we're on the case. So what are those clues we should be looking for?
Think of them as Graham's 7 criteria for stock selection, the hallmarks of a high-quality company that can stand the test of time.
Hit me with the first one.
Adequate size. He believed in sticking with companies that have a substantial track record. He suggested industrial companies with at least $100 million in annual sales and utility companies with at least $50 million in assets.
So no risky startups with a fancy website, but no real revenue.
Not exactly. He believed that companies with significant size are less susceptible to sudden shocks. They're going to have more established operations.
Makes sense. What's next on our detective's checklist?
Financial strength. This is where you really start digging into the balance sheet. Graham wanted to see a 2-to-1 current ratio, meaning current assets are at least double current liabilities. He also set limits on long-term debt.
Got it. So it's like checking a company's credit score before you decide to lend them your money.
That's a great analogy. We want to see that a company can manage its finances and isn't drowning in debt.
Okay, financial strength, check. What's next?
Earning stability. Graham wasn't looking for companies with roller coaster earnings.
Right.
He wanted to see a consistent track record
Okay.
of profitability with no deficit years in the last decade.
Consistency is key. We want companies that can weather those economic storms and still come out on top.
Right. And speaking of weathering storms, Graham also valued a solid dividend record, at least 20 years of uninterrupted dividend payments.
So not only are these companies making money, they're also sharing those profits with their investors. That's a win-win.
It is. Dividends can be a great source of passive income, and a long history of payments shows commitment to shareholders.
I'm starting to see a pattern here. Reliable, consistent, and shareholder-friendly. What's next?
Now we get into the growth aspect.
Yeah.
Graham wasn't just looking for stagnant companies. He wanted to see earnings growth, at least a 1/3 increase in per-share earnings over the past 10 years.
So it's not just about maintaining the status quo, it's about showing steady, sustainable growth.
Precisely. And now this is where it gets really interesting.
Okay.
The two criteria that set Graham apart are moderate price-to-earnings ratio and moderate price-to-assets ratio.
Okay.
This is where his value investing philosophy really comes through.
I'm ready. Tell me about these ratios.
The price-to-earnings ratio, or PE ratio, tells you how much you're paying for each dollar of a company's earnings. Graham suggested a maximum of 15 times the average earnings of the past 3 years.
So you're not overpaying for future potential.
Right. And then the price-to-assets ratio, or PB ratio, compares the market price of a stock to the value of the company's assets if it were liquidated. Graham suggested keeping this ratio below 1.5 times book value.
So you're essentially looking for a bargain, a company that's trading for less than it's actually worth.
Exactly. These ratios are all about finding that margin of safety, making sure you're not overkeying.
This sounds like Graham really emphasized getting a good deal. But with all these criteria, how many companies could actually pass this test?
Well, Graham applied these criteria to the Dow Jones Industrial Average back in 1970. Out of those 30 blue-chip companies, Guess how many met all 7 requirements?
I'm going to say less than half.
You're right. Only 5 companies made the cut. American Can, American Intel, Anaconda, Swift, and Woolworth. It just goes to show that finding high-quality investments takes work even among the most well-known companies.
Wow, only 5. What set those companies apart? Let's take a closer look at one of them, say American Intel. What made it a Graham-approved investment back then?
Well, in 1970, AT&T was a telecom giant, essentially a monopoly,
Wow.
providing telephone services to most of the country. This gave it incredible stability and consistent earnings.
Yeah, that makes sense. People relied on their phone service regardless of what the economy was doing. What about its financials?
AT&T had a rock-solid balance sheet. It was a massive company, steady profits, and a long history of paying dividends. Its size and financial strength definitely gave it an edge.
So it wasn't just a popular company, it had the financial strength to back it up.
Exactly. And this brings us to another point Graham made. While being selective is important, it's equally important to diversify.
So don't put all your eggs in one basket.
That's right. And Graham's emphasis on diversification is rooted in the fundamental truth about investing. It's virtually impossible to consistently predict which stocks will outperform the market.
So even with all the fancy algorithms and analysts, nobody has a crystal ball.
Precisely. Trying to pick winners all the time can be a recipe for disaster. You might get lucky a few times, but over the long run, it's really hard to beat the market consistently.
So diversification helps reduce that risk. If one of your picks doesn't do well, it doesn't wipe out your entire portfolio.
That's the idea. By spreading your investments across different companies, different industries, and different asset classes, you're creating a safety net. You're acknowledging that you can't predict the future, but you can be prepared.
It's like having a buffer zone, so you're not completely exposed to the whims of the market. This makes sense, especially with what we know about the efficient market hypothesis.
Ah, yes, the efficient market hypothesis. This concept has revolutionized finance.
I've heard this term, but I admit it makes my head spin a little. Can you break it down for us?
It basically means that stock prices already reflect all publicly available information about a company.
Okay.
Think of the market as this giant puzzle
Okay.
where everyone has access to all the pieces.
So it's not like someone has secret info that gives them an edge?
No. The efficient market hypothesis suggests that all the relevant information is already baked into the price. This makes it so challenging to consistently outsmart the market.
Okay, I think I'm starting to grasp this. But if it's so hard to beat the market, what's the point of even trying? Why not just put all your money in an index fund and call it a day?
That's a valid question, and for many investors, index funds are a great strategy. But Graham believed that by applying a disciplined, value-oriented approach, you could identify mispriced assets and potentially get superior returns.
So it's not about throwing darts at a board, it's about doing your research and understanding the value of a company. That's where Graham's concept of intrinsic value comes in, right?
Yes, intrinsic value is all about recognizing that a stock price doesn't always reflect a company's true worth.
So sometimes the market gets it wrong, and that's where savvy investors can find those bargains.
Exactly. And Graham developed techniques for estimating intrinsic value, but it all boils down to analyzing a company's financials, its industry position, and its long-term prospects.
This all reminds me of what we talked about earlier.
Yeah.
Those two main approaches to security analysis. Prediction qualitative versus protection quantitative. What's the difference again?
The prediction or qualitative approach is about trying to anticipate future earnings growth. It relies on things like industry trends, management quality, stuff that can be hard to really quantify.
It's like trying to forecast the weather, right? There are so many variables at play, it's tough to be accurate.
Exactly. And Graham wasn't a fan of this approach. He thought it was too subjective, too prone to error.
Which is why he favored the protection or quantitative approach.
Precisely. This method emphasizes buying stocks at a discount to their intrinsic value, creating a margin of safety.
So instead of trying to predict the future, you're focused on finding undervalued companies that are already doing well.
That's the idea. That's where the quantitative approach shines. He believed that by focusing on concrete data, investors could make smarter, less emotional decisions.
This is all fascinating. I'm already looking at my own portfolio a little differently. But before we go any further, let's take a quick break. When we come back, I want to talk more about Graham's thoughts on specific industries, like public utilities and railroads. Stay with us.
So we learned that even in the Dow Jones Industrial Average, not that many companies actually passed Graham's test. But I'm curious about some of the industries he specifically mentioned. He seemed really into public utilities.
He did. He called them a haven for the defensive investor.
That sounds nice. Why did he think they were so great?
Well, remember, he was writing in a different time, but his reasoning still has some value. Utilities offer essential services like electricity, gas, water, things people need no matter what the economy is doing.
Right. Even if the market is a mess, people still need to keep their lights on.
Exactly. That consistent demand means utilities tend to have pretty stable earnings, which is perfect for a defensive investor. The prices also tend to be less volatile compared to something like tech stocks, which are all over the place. Less drama, more dividends. Sounds good to me. He mentioned dividends specifically, right?
Yes, he did. Utilities often have good dividend payouts, which is a nice stream of income for investors. This was especially appealing back then when there weren't as many investment options.
Okay, but you said earlier that some of his reasoning might not apply as much today. What's changed in the world of utilities?
The industry's gone through a lot of changes. Deregulation has brought more competition, and the rise of renewable energy has made things more complex.
So it's not as simple as just picking any utility company and calling it a day.
Right. These days, you need to be more careful. Things like a company's involvement in renewable energy, the regulations they face, and their debt levels all matter a lot.
So the haven might not be quite as safe as it used to be, but there's still good opportunities if you do your research.
Absolutely. You got to understand the details and adapt as things change. Now, switching gears a bit to another industry Graham was cautious about, railroads.
Yeah, he wasn't a fan, was he? I remember him saying there wasn't a good reason for most investors to buy their stock.
His skepticism came from the fact that railroads were already facing competition from trucking companies and airlines, even back then. Plus, there was a lot of regulation impacting their profits.
It's interesting how some industries just seem to struggle no matter the time period.
It is. And it reminds us that even industries that seem stable can get disrupted. In the case of railroads, these new ways of transporting things really started eating into their market share.
It's a classic business school case study, right? Companies have to adapt or die.
Exactly. Graham's warnings about railroads are a good lesson. Investors need to really think about an industry's long-term future and understand what the competition looks like.
Okay, so no jumping on board without a thorough check first. But let's go back to diversification for a second. It seems like a pretty fundamental concept.
It is. Graham believed in not putting all your eggs in one basket. He understood that it's almost impossible to always know which stocks will do better than the rest.
Even with all the data and algorithms we have today, nobody can predict the future perfectly.
Exactly. Trying to pick winners all the time is like gambling. You might get lucky a few times, but over the long haul, it's really hard to beat the market.
So diversification helps with that. If one investment goes bad, it doesn't ruin everything.
Right. By spreading your investments across different companies, different industries, and different types of assets, you're creating that safety net. You're accepting that you can't predict the future, but you can be ready for anything.
It's like creating a buffer for your portfolio so you're not totally vulnerable to the market's ups and downs. And this connects to the efficient market hypothesis, right? The idea that stock prices already reflect all the information that's out there.
Yes, exactly. The efficient market hypothesis says the market is pretty good at taking information and using it to set prices.
So it's like this massive information machine constantly taking in news, reports, opinions, everything.
That's a great way to think about it. And because of this, trying to outsmart the market by consistently finding undervalued stocks is really difficult.
So if everything is already in the price, where is the opportunity?
That's a tough question that a lot of investors ask. For some, this leads them to things like index funds, which just aim to match the market instead of trying to beat it.
Makes sense. If you can't beat them, join them. But Graham seemed to think there was still a way to find mispriced assets.
He did. He thought that if you were disciplined and focused on value, you could find opportunities where the market was a little off.
So it's not about having insider information, but about having a system to figure out what a company is really worth.
That's it. That's where the concept of intrinsic value comes in. It's about recognizing that a stock price doesn't always perfectly match the true value of a company based on its fundamentals.
This all reminds me of those two different approaches to analyzing companies. It seems like Graham was definitely on the side of checking the foundation instead of trying to predict the future.
You got it. He was more into the protection quantitative approach. You're focused on buying stocks for less than their real value, which gives you that safety net.
It's like being a detective, but instead of looking for fingerprints, you're analyzing balance sheets and cash flow statements.
That's a great analogy. That's where Graham's quantitative approach really works. He thought that focusing on the numbers helped investors avoid emotional decisions and be more rational.
This is really interesting stuff. It's making me rethink my own portfolio. But before we go any further, let's talk more about Graham's thoughts on specific industries. I remember he had some pretty strong opinions about financial companies even way back then. He seemed to think they were risky.
He did. And his concerns about financial companies are even more relevant today because our financial system has gotten so complex.
I can only imagine. So, what made him so cautious about financial companies?
For one thing, he found their business models to be more difficult to understand compared to, say, a manufacturing company. It's harder for the average investor to really know what's going on.
That's true. Banks, insurance companies, investment firms, they're dealing with stuff that's hard to wrap your head around.
Exactly. He said that figuring out if these companies are financially healthy requires a deep dive into their balance sheets, understanding their risks, and deciphering all the jargon in their financial statements.
So, not only is the business complicated, but figuring out the risks is a challenge too.
Right. He was especially worried about things like too much debt and risky lending practices within the financial industry. And we've seen in recent years that those worries were valid.
The 2008 financial crisis definitely proved that. It seems like no matter how many rules we make, there's always a chance for things to go wrong.
That's true. And it just reinforces Graham's point about being extra careful with these types of investments. You really have to understand the details of how these businesses work.
So it's not just about the potential gains, it's about knowing how much you could lose.
Precisely. It goes back to Graham's idea of being a defensive investor, minimizing your risk, and protecting your money.
So, to sum it up, do your research, read the fine print, and if something doesn't feel right, walk away.
That's great advice for any investment. Now let's move on to another big part of Graham's philosophy: avoiding the common traps that investors fall into.
I'm all ears. What kind of traps should we be watching out for?
One of the biggest dangers is emotional investing, letting your feelings of fear or greed control your decisions instead of logic.
It's easy to get caught up in the excitement or panic when the market is moving up and down quickly.
It is. But Graham emphasized how important it is to stick to your plan, focus on the long term, and not get carried away by the ups and downs of the market.
So it's like having a strong plan to help you through those crazy times. Do you have any tips for staying calm when the market is going wild?
One good strategy is to remind yourself that those short-term swings are often just noise, not real changes in the value of companies. Having a well-thought-out plan can help you stay focused and avoid making impulsive decisions.
So it's like having a map to guide you when the path gets difficult. What other traps did Graham warn about?
He also talked about the difference between speculation and actual investing.
Okay, explain that to me. Those terms seem to be used interchangeably a lot, but Graham saw them as different things.
You're right, there's a big difference. Graham saw a speculator as someone who's basically gambling on short-term price movements, hoping to make a quick profit. They're not interested in owning a piece of a business, just making a fast buck.
So it's like flipping a house versus actually living in it.
Exactly. A true investor is focused on owning a piece of a good business and benefiting from its growth over the long term. They look for companies with strong fundamentals that have a history of making money.
So it's about being a business owner, not a gambler. That makes a lot of sense. Now, did Graham ever talk about growth stocks? I mean, growth has to be a factor, right?
He did, and while he wasn't against growth stocks, he was very cautious about paying too much for that growth.
So it's not just about how fast a company is growing, it's about whether that growth is worth the price you're paying.
Right. He said that investors often get caught up in the hype of a fast-growing company and end up pushing the price up too high.
It's like getting caught up in the excitement and forgetting to check if the company is actually worth that much.
Exactly. While growth is good, Graham emphasized that you need to see if that growth is sustainable and if the price you're paying gives you a margin of safety.
That margin of safety idea comes up again.
Ugh.
It's like a central theme in his thinking.
It is. It's a key part of being a defensive investor. You want to protect your money, even if your predictions about a company's growth turn out to be wrong.
This has been such a fascinating deep dive into Graham's work. It's clear why his book is considered so important. His ideas are still relevant today.
I agree. His focus on value, managing risk, and thinking long-term is really valuable for any investor in any market.
Are there any final words of wisdom from Graham that we should remember?
He famously said, "The investor's chief problem, and even his worst enemy, is likely to be himself." If you understand the principles of defensive investing, stay disciplined, and don't let your emotions control you, you can overcome those internal challenges and reach your financial goals.
So true. It's about having that intelligent investor mindset, always learning, always adapting, and making informed decisions.
Exactly. And remember, investing is a marathon, not a sprint. Enjoy the journey and build a portfolio that can last.
This has been fantastic. I feel like I understand Graham's philosophy much better now and how to use it for my own portfolio.
That's great to hear. Remember, we've just covered some of the main points, and there's always more to learn. Keep exploring, keep asking questions, and stay curious.
Thanks for joining us today. We hope you found this deep dive helpful. Until next time, happy investing. So last time we were in the middle of discussing Graham's take on financial companies.
Yeah, he was pretty wary of them, wasn't he?
He was. Even back then, he thought they were especially risky. And I imagine with today's complex financial systems, his concerns are even more relevant.
Oh, absolutely. I mean, look what happened in 2008.
Exactly. It seems like no matter how much regulation we put in place, things can still go sideways.
You're right, and Graham knew this. That's why he stressed being extra cautious with these companies. You really have to dig deep and understand their businesses.
So it's about looking at both sides of the coin, right? Not just the potential rewards, but also how much you could potentially lose.
Exactly. That's a big part of being a defensive investor, protecting your money and minimizing risk.
So, long story short, do your research, read the fine print, and if something doesn't feel right, walk away.
Solid advice for any investor. But speaking of things to watch out for, Graham also talked about avoiding some common pitfalls that investors often fall into.
Okay, I'm all ears. What kind of traps are we talking about?
One of the biggest ones is emotional investing. Letting fear or greed drive your decisions instead of logic and analysis.
That's easy to say, but much harder to do when the market is swinging wildly. It's tempting to panic or jump on the latest hot stock.
Oh, for sure. But Graham was all about sticking to your plan, focusing on the long game, and not getting carried away by all the noise.
So it's about having a solid plan and sticking to it. Any tips for staying level-headed when the market is going crazy?
One good strategy is to remind yourself that those short-term ups and downs are often just distractions. They don't always reflect real changes in the value of companies.
Okay, that makes sense.
Having a clear investment strategy can really help you stay focused on the big picture.
So it's like having a map to guide you through those tough times. What other pitfalls did Graham warn about?
He was also big on the difference between speculating and investing.
Ah, yes. Help me with that distinction. Those terms seem to get used interchangeably a lot, but Graham clearly saw them as different things.
You're right, there's a big difference. Graham saw a speculator as someone who's just betting on short-term price movements, trying to make a quick buck. They don't care about owning a piece of a business, they just want to cash in quickly.
So it's like flipping a house versus making it your home.
Exactly.
Yeah.
A real investor, on the other hand, is focused on owning a piece of a solid business and benefiting from its long-term growth. They look for companies with strong fundamentals that have a history of making money.
So it's about being a part owner, not a gambler. That makes a lot of sense. Now, where did Graham stand on growth stocks? Growth is important to consider, right?
Absolutely. And he wasn't opposed to investing in growth stocks, but he was very careful about paying too much for that growth.
So it's not just about how fast a company is growing, it's about whether the price tag makes sense for that growth.
Right. He pointed out that investors often get so excited about fast-growing companies that they drive the price up way too high.
Yeah, it's like getting swept up in the hype and forgetting to check if the company is actually worth that much.
Exactly. And while growth is good, Graham stressed that you need to see if that growth is sustainable and if the price you're paying gives you that margin of safety.
That margin of safety pops up again. It's like a core idea in his thinking.
It definitely is. It's a big part of being a defensive investor. It's
Okay.
about protecting your capital, even if your predictions about a company's future growth don't quite pan out.
This has been such a fascinating deep dive into Graham's work. It's amazing how relevant his ideas still are today.
I agree. His focus on value, risk management, and a long-term perspective are as valid as ever.
Any final words of wisdom from Graham that we should keep in mind?
He famously said, "The investor's chief problem, and even his worst enemy, is likely to be himself." So if you understand the principles of defensive investing, stay disciplined, and don't let your emotions rule your decisions, you're already on the right track.
Words to live by. It's about having that intelligent investor mindset, always learning, always adapting, and making informed decisions.
Exactly. And remember, investing is a marathon, not a sprint. Enjoy the journey.
Great advice. This has been an awesome deep dive into Graham's investment philosophy. Thanks for joining us today.
My pleasure. Happy investing, everyone.